Welcome to a weekly video called the Deep Dive Video. And if you are the first time watching any of the videos that I post, I always want to explain what I mean by this video. I do a video each day. I do a number of weekly videos. And then after I get done with the three main videos over the weekend, I go through all the charts, especially the daily charts, and I look through those charts that I really didn't talk about. Because in the other videos, I like to only show videos that are actually telling us something right now. That means I exclude some charts from those other videos. Well, I take all those excluded charts and put them into this video. There are also some other charts that are unique just to this video. This is not meant to be a standalone video. The daily video is where I do most of the analysis, but the weekly video, the intermarket analysis video, after this, I'll be doing what's called the what to watch video. At least the way I do things, it's meant to be taken all together. Now, I know my videos are longer. I go through so many charts, but if you really want to be successful in this, it's what you need to do. It's what you don't know that can really hurt you in the markets. Now, a week ago, I was unable to prepare this video. At that time, I was in Jerusalem, Israel, and I was getting things ready for this particular video. And right about then was when I heard that things could be escalating. And so all of the videos had to stop, had to make travel changes and get out of Israel as soon as possible. And it took 4 days to get back. And now I'm back where I currently reside, and I'm able to do the video this week. So this is for Monday, October 7th. I do have a thing called the SPX investing program. From now until the end of 2024, it is free. There are additional videos that I post. There are courses on there that I'll be doing live, that I'll also be pre-recording and putting on the website. Feel free to check that out and see if it's of interest to you. If you want a link to take you to the website, there's a link in the description below this video. There's also another link that will take you to a video that talks about the program. If you have any questions, you are more than welcome to email me. If you want to talk about it, we can set up a time on Zoom or Skype or Messenger or whatever you use. Also, the daily video, as I mentioned, that's the real foundation of the analysis that I do. If you notice right down here, this is the video I'm preparing now, the deep dive video. I also do a what to watch video. I do supplemental videos, which I really only post on the website now. There's a weekly video and then an intermarket analysis video, but all of these are meant to tie into the daily video. Okay, let's go back and look at some of the charts here, and I think I have to change my laser pointer. It's supposed to look a little different than it is right now. Okay. So we use this chart mainly for just information. This looks at the VIX over a long period of time. And when the market's really going down, the VIX goes into a higher range, like we saw from 2008 into 2012 or so. It was finally 2013 when it really started to get into a lower range. When the VIX is lower, the market tends to be more positive. Well, then we went into the COVID crash. We went to a higher range again. We've been coming down. Now, over the last few months, we've been seeing the VIX as measured by a 50-day exponential moving average starting to go up. And we're a little bit concerned about the VIX right now. The market appears to be somewhat vulnerable. Things are still positive, but we can even gyrate in these lower ranges for periods of time. But we'll be keeping an eye on this. We don't make decisions based on this chart. We just want to look at it and get the information from it that we are in a lower range, which is more positive for the market. I also measure the speed of the VIX as measured by the RSI based on 9 periods. When I show this chart is when we get an extreme positive or negative reading. We're not getting one of those right now, so there's been no need to show that chart. Also, we do a ratio between the VIX and then kind of like an indicator that goes along with the VIX called the VVIX, or the VIX of the VIX. And this is not really telling us all that much. Sometimes it really trends higher, sometimes it trends lower. We've been chopping more or less sideways lately. We also keep an eye on sentiment. And I show this chart a lot in the daily videos, but usually only when we're above this red line, which is a moving average. We are coming back up a little bit here, but according to this indicator, we're not seeing an awful lot of fear in the market. This is one of the older indicators, and it was originally developed to use with mutual funds, which only have a closing value known as the net asset value, or NAV, but I still find it useful. It can kind of confirm what we're seeing in the VIX and other studies of the VIX and other charts that we look at to measure sentiment. But since we're below the moving average, I haven't been showing this chart. Then another study is looking at a correlation between the VIX and the S&P 500. Now, we've been getting really low readings lately, so that's why I haven't been showing this chart. We're starting to come back up, so we'll keep an eye on this. When we get above this dashed line, this can mean the market is getting very nervous. We may not see things all that negative with some of our other VIX studies, and sometimes we see it with this study, so I just like to keep an eye on it, and I will be watching this to see if it's trying to tell us something. Then we do ratio between the volatility of stocks measured by the VIX and the volatility of bonds measured by the MOVE index. And this is having a tendency to go up. I mainly follow the moving average here, the red line. And sometimes when this is going up, that means the market's going up. Sometimes when this is going down, that means the market is going down. We are going up right now. Now, there's not a hard and fast rule with this. There are times when we're going down here, but we've been going up with stocks. So we don't want to use this all by itself. We want to look at other charts to get the proper context. Then we keep an eye on where are we in relation to the previous all-time high. This was set in early January 2022 before we had a very difficult year. Well, we finally were able to go up and set new all-time highs. And as of Friday's close, we're 19.35% above the previous all-time high. Then stockcharts.com has this thing called technical alerts. And what they try to do is if something happens that's significant, like an index crosses a specific number, like the NASDAQ or the NASDAQ 100, or a sector, something happens, or a technical event happens. Well, they trigger what are called technical alerts. And what you see right here, these are all of the alerts for the whole week. Now, I go through these in the daily video one day at a time. But typically, when we're having a more positive day, you see a lot of blue or green here, depending on what color you see. When we're really under pressure, we see an awful lot of red. Well, we saw an awful lot of red throughout the week. And then finally in Friday's session, this is October 4th, this is when the market started to move higher and we saw a pretty good end to the day. Even though the S&P, it says it crossed below 5,700, it ended up getting back above 5,700. And then stockcharts.com has this other tool where they try to remove all emotion because that's really what technical analysis is supposed to do. Unfortunately, you can have 10 people look at the same chart and come to 10 different conclusions, either positive or negative. So there's a lot of confirmation bias, even in technical analysis. Well, stock charts just takes basic technical analysis indicators, puts them together, and then ranks things on a score of 0 to 100. Now, you can do this with stocks. You can do it with sectors. I use it with indexes. And there's 5 main indexes that I follow. The S&P, because that's the foundation of what I do. The Dow, the NASDAQ 100, the mid caps, and the small caps. So there are 5. And then I rank them to see what's looking best right now. Coming in first place is the SPY, the S&P 500. Now, when it's really strong, this score will get above 90. But we are coming in fairly strong right now at 82.6. Then in second place, which had really been lagging behind, are the QQQs, which is the ETF for the NASDAQ 100. It's coming in at 81.9. We want to see the S&P doing well. We want to see the QQQs doing well if we're positive on the market, because that's where the Magnificent Seven stocks are that really drive the indexes higher. So this is looking fairly positive. Then in third place is the Dow. Now, the Dow's only made up of 30 stocks, and this is the DIA. That's the Diamonds, which is the ETF for the Dow. It set an all-time high on Friday, but it's still not really looking the strongest as far as technical analysis is concerned. It's looking good, but it's coming in third place at 73.9. Then we have the small caps, which have gone from hot to cold a lot in 2024. You can see there are times when we get really high readings, then we get really low readings. They're starting to show some improvement here, but not really all that strong, at least yet, coming in at 56. And in last place are the mid caps. Now, there were times when I did this video throughout 2024, and for a number of weeks in a row, mainly last spring, the mid caps were doing the best. But they've been really lagging behind over the last number of months, and they're coming in with a score of 51.6. Then we look at a short-term chart. This is a rainbow with some short-term moving averages plotted on here, and I changed the color so it looks kind of cool and everything. This goes from 10 periods up to 50 periods with simple moving averages, and the lines are going up and prices above all the lines. So this suggests, by just glancing at this, that the short-term trend is still positive, and we're seeing that confirmed by other charts that we look at. And then sometimes we get a little ahead of ourselves. And so I have this thing called the boom indicator, and this measures how far away are we above or below a particular moving average. When we get too far away from a moving average, the moving average tends to act like a magnet or a rubber band, and price will snap back to it. And that's why we call it boom. It'll get too far away and then boom, it comes back. And so on this chart is measured how far away are we from the 20, 50, and 200-day moving averages. We're not extreme right now. We use this like an oscillator. When we get an extreme positive or negative reading, we are positive since we're above zero with the 20 and 50, and we're even looking pretty good here with the 200, but not extreme. When we're not getting extreme readings, I don't show this chart in the videos. Intermediate term, another rainbow, going from 50 periods up to 100 periods. The lines are going up and prices above all the lines, so the intermediate term trend is still positive based on using moving averages to measure that. Then we keep an eye on the 50-period moving average. Now, we're dealing with the 20-period moving average in pretty much all of the daily videos now. I measure short-term as the 20-period moving average, intermediate is the 50-period moving average, and then the long-term trend is the 200-period moving average. We're well above this, and we even see the blue line above the red line. The blue line is an exponential version of the 50-period moving average, and that tends to move faster. The red line is a simple moving average, and that's what most people tend to use. I always get the question, which one is best? I plot them both here. So we can get some insight just from plotting both of these. But since we're kind of far away from the 50-period moving average, there's been no need to show this chart. If we really start to come down and we break below the 20-period moving average, then I'll start to show this chart in the daily videos. And that same basic thing here with the 100 period. Now, I use 200-period moving averages, but when we're really going sideways and we're not really trending all that much, sometimes the 100-period moving average can be useful. This is also looking positive here. We're above all the lines that are plotted, so unless we start to really drop, I haven't been showing this chart. Then standard deviation. This is not measuring direction, it's measuring speed. And we've been chopping around pretty much sideways for quite a while now. This calculates it over the last 10 periods, and we're getting a very low reading. Again, this is like the ulcer index. When we get above the moving average, that's when I use this chart in the videos. When we're getting a very low reading, then I drop it from the daily videos. The mass index. We did get a signal over the summer. We crossed above the red dashed line and then the blue line. The third part of this trigger or signal is when we cross back down below the red dashed line again, and that tries to signal a reversal. Well, we're getting a pretty low reading right now, so there's been no need to show this chart. Also, the Pring bottom fisher, which is actually positive, we're above the moving average here. But this indicator was designed so that if we're really screaming to the downside and we're looking like we're hitting a bottom, then this starts to cross over positive. That can confirm if what we're seeing in some other charts, if it also looks like we're bottoming. Well, we're just coming off of all-time highs here, so this signal is pretty much irrelevant. Then we measure the distance away from the 20-period simple moving average. If you notice, times when the market runs into trouble, we get up around this 15% above the 200-day moving average. That happened last spring. It also happened over the summer. Now, we're not even 10% away from it now. But if this really starts to go up, I'll be showing this chart because then we're getting a little overextended to the upside, and that can make the market vulnerable. But right now, it's not really giving us any insight. Then we measure, okay, from the low from 2023 in October until Friday's close, we are up 28.63% from that low. And this is the 2023 low, not the October 2022 low. That would be an even greater percentage, but I don't have that on this chart. Just to give you an example, we were going up last summer and we hit the high on July 16th, all-time high, and then we really started to go down. Now, 10%, that's kind of the magic area between a decline or a pullback and an actual correction. We got close to that 10% level, and that's when the smart money started to come in and buy and push this back up. If we start to decline, I'll be doing a similar kind of measurement here, but we're not even showing anything like that, at least yet. Then we use another momentum oscillator called the Connors RSI. It's really all over the place from day in and day out. I only use this when we're getting an extreme positive or negative reading. That's not what we're seeing right now. Then we have some anchored moving averages, which really are not helpful at this point because they're usually marked from lows or highs of other times. And we're well above all of these moving averages here, and they try to project things forward, where a regular moving average uses historical data to calculate its current value. This tries to look out into the future. And since we're far away from these lines, I haven't been showing this chart. CMB composite. I was showing it a lot in September. We were getting an extreme reading. Since that time, we've dropped down, so I haven't been showing this chart anymore. Then we have the percent B indicator, and this measures when we're above or below the Bollinger Band, either upper or lower band here. We're not. And so there's been no need to show this chart. Now, there's a whole book written about how you can use Bollinger Bands. What I use right here is just one implementation of them. Then point and figure, we didn't get any new X's or O's drawn. This is still looking positive though, since on September 19th, we're getting a double top breakout, which is kind of interesting because on the weekly version of this chart, we're seeing pretty much the same thing, but it's calling it a triple top breakout. I'm not sure what to make of that, but this only adds an X if we go up by a certain amount. It adds an O if we go down by a certain amount. And since we're seeing a lot of X's here, we have blue lines underneath, which are upward sloping trend lines. This chart is still looking positive. And we want to keep an eye on the S&P 100 compared to the S&P 500. We're not really seeing any big disconnect between the two. And there's other studies that I look at that compare how these are doing with each other. A long-term rainbow goes from 50 periods up to 250 periods. All the lines are still going up. We're above all the lines, so the long-term trend is still positive. This is also a long-term oscillator called a special K, just like the serial. We're above the red line, but we might see one or two crosses a year with this particular chart. In fact, we haven't seen a change in 2024 at all. So there's been no need to show this chart since it would just be showing the same thing over and over. Then here we have a weekly chart of the S&P on top, a weekly chart of the German DAX in the middle area, and we look at the correlation between stocks in Europe and stocks in the US. It had really been dropping off, but we're seeing a little bit of a pickup here as they're having a tendency to go in the same direction at the same time. It doesn't mean they're going up or down. It just says they're going in the same basic direction. Then some support and resistance, going back to the all-time high that was recently set with the S&P. If we really start to fall, then some of these retracement levels may come into play. Some broad market measures, I haven't been showing this. This is the QQQs. Once we got above all of the moving averages here and the blue line crossed above the red line, I stopped showing this chart. I have a number of different NASDAQ 100 charts that I do show in every daily video. I stopped doing this one because it's positive. And if we start to really drop here, then I'll start showing this chart again. And we look at a thing called the Vixen. You gotta love that name. The VIX measures the volatility of the S&P 500. The Vixen measures the volatility of the NASDAQ 100. And I don't use this upper area here because it's got a lot of crazy icicle data here. But we are seeing a bit of a pickup in volatility. We're also seeing a pickup with the VIX, with the S&P. So we just want to keep an eye on that. That's why I watch it every day and talk about it in the daily videos. And we look at a ratio between the Qs, the NASDAQ 100, and the diamonds, the Dow, and then the correlation between the two. It's coming down a little bit here, but it's still fairly strong when we compare it to the S&P. Because the QQQs, that's tech. The diamonds, that's supposed to be the best of the best stocks. So we look at this ratio, compare it with how it's going with the S&P 500, and they're going in the same basic direction right now. So that just tells us that the broad market is really holding up pretty well. We look at the Dow and the transports. The Dow setting an all-time high. The transports just pretty much chopping sideways. The transports are not really helping the market all that much in 2024. The bank ETF, we want to keep an eye on things in case things really start to fall apart. The financial sector is looking strong, and I show that in the daily video. Then one aspect of the financial sector is the bank ETF here, still looking pretty solid. We did fall down below the 50-day moving average, but in Friday's session, we came back above it. And we want to keep an eye on the smaller banks as measured by the regional banking ETF. And we're in an uptrend overall, but we have been falling back. When we really dove down here, this is when some of those smaller banks like Republic Bank, Silicon Valley Bank, earlier in 2024, New York Community Bank, that was just wreaking havoc on this particular ratio. Well, for right now, we're holding up, but we want to keep an eye on this too. Then rate of change charts, I just use these for information. This goes based on Friday's close all the way back 250 periods. We are looking positive here. And then here's a longer term chart getting above this blue line, but we can go above that. That's just showing good longer term momentum. Keep an eye on bonds. We look at cash, compare it with 3 to 7 year bonds. We really want this ratio to go down because when this ratio is going up, that means there's uncertainty about interest rates and inflation could be a problem. Well, we've been coming down and we're still in a downtrend here, but see how we're spiking up lately? We want to watch this to see if something is changing. The context right now is that the market will have a soft landing. Is that going to change going forward from here? And then we look at the long-term bond ETF and compare it with the S&P 500. We can see on a shorter, longer-term basis, the relationship isn't as strong. And you can tell by looking at this. The red line's going up as the blue line's going down lately. And we're not seeing a real strong correlation even on a shorter term basis. Short term is 10 periods, long term is 50 periods. We also do that same kind of thing with the QQQs of the NASDAQ 100 to the long-term bond ETF. They're still pretty much neutral with their correlation currently. And we look at the US 10-year yield on top and we subtract the German 10-year yield. And since US rates are higher, we get a positive answer. And believe it or not, the interaction between interest rates and the US dollar index can be pretty strong. We plot the US dollar index in the middle and we see that there's a pretty strong correlation between these. So we want to keep an eye on this as interest rates are changing, as geopolitical events are possibly unfolding, specifically in the Middle East. We've got an election coming up, so we just want to see if anything gets out of line here. And we keep an eye on the 2-year Treasury yield. Now, typically when this is going down, that's positive for the S&P. Are interest rates going down because the Fed is coming in and cutting rates just to kind of stimulate the economy and the inflation is under control? That's what it appears to be right now. But if this really starts screaming down because the Fed has to cut rates because of a black swan event or a COVID lockdown or something, that changes all the context right there. Well, right now, we did come back up a little bit here, but we have been coming down overall, and that's been positive for the S&P. Then we keep an eye on the 10 to the 2-year yield curve. We finally went back to being uninverted, but you notice how we're coming back down a little bit here? Are we in danger of going inverted again? We'll just watch that. Another yield curve that I follow is the 10 to the 3-month, where we are coming back up, but we're still inverted with this particular yield curve. Then I have some things called possible positive scenarios. These came in real handy back in 2022 when the market was under a lot of pressure. And I have a number of different charts that can help us figure out, okay, are we hitting a bottom? Are we starting to come back up after we've really been coming down? A lot of those charts I still use in the daily videos, but there's some other charts here in this video that I don't use unless they're really telling us something. The first one I use like an oscillator. These are the stocks above their 200-day simple moving average inside of the S&P. We're not getting an extreme positive or negative reading now, so that doesn't really help us there. We are positive since we're above 50 and we have been going up lately. We do that same basic thing with stocks above their 50-day moving average. Use it like an oscillator, but not getting an extreme reading now. And we're above 50 as well. So that's still positive. We also look at the mid caps and then the small caps. But we're not really getting any insight from these charts currently. So thank you. I hope you found this helpful. I hope you're having a really nice weekend, and I will talk to you in the next video.